Well, let me just tell you how we did it, how Paul Volcker did it in the late 1970s and early 1980s, when we had very high inflation. I think mortgage rates were 16, 15, 17%. The prime interest rate when we took office on January 20th, 1981 was 21.5%. That's really high. What you have to do to really bring inflation down is to let interest rates seek their own level. Right now, if you asked yourself the question, what would it take to attract me to buy a 10-year government bond in this type of environment? You know, the yield on that government bond is 3.55% or something like that right now. I wouldn't buy a bond for 3.55% if it made me. I mean, to get me to be willing to buy that bond, I think the yield would have to be 10, 11, 12%. Paul Volcker let those yields go straight up. He did not like price controls or interest rate controls. He let the interest rate go way up to where it was, to all of a sudden made money tight in the system. That's the first part he did. It also reduced the balance sheet of the Fed dramatically, which meant that they didn't have the supply of money, which would accommodate and supplant and let that inflation go. The second part of the project was you have tight money, and then you want to have an increase in the supply of goods. We had the tax cuts under Reagan, which increased output, employment, and production. I think I may have mentioned in this the last time I was with you, Michelle, but from June 83 to June 30th, 1984, that's an 18-month period. I mean, a year and a half, U.S. real GDP grew by 12%. 12%, that's at an 8% per annum rate, which is Chinese growth rate. So we increased the supply of goods, we tightened the supply of money, and inflation just tumbled like a stone. You know, inflation is too much money chasing too few goods. We made it more goods and less money, and we brought the inflation down. This economy under Biden and Powell is doing just the opposite. They should have interest rates right now in probably the 7, 8, or 9% range, and they're not. They're raising them a little bit at a time, which is just not the right way. If you've got a bandage on and you want to take it off, don't take it off a little bit. Just rip it off and get it done with. They should have done that a long time ago, but they didn't. And the Biden administration should be very expansive in the production of goods and services so that we have less money chasing more goods, and that will bring the inflation down. So far, they have really not done that. They've just inflicted the pain, but they haven't gotten any of the gain. The whole thing about Paul Volcker that made Volcker so wonderful was he let interest rates seek their own levels, and that made bonds attractive so people would buy the bonds. The Fed didn't have to buy them and thereby create a lot of money. That's the real problem, and he has not done that yet. The Fed balance sheet today is a little bit less than $9 trillion.
So how aggressive do you think the pace of quantitative tightening needs to be?
Yeah, if it must be done, best 'twould be quick. My view is you've got an inflation problem now. We had a lot of things happening that I'm sure are affecting the Fed's thoughts. For example, in the beginning, over a year ago, you saw the inflation numbers picking up very rapidly. You remember that? And we had oil prices going up, with spot commodity prices, lumber prices. And so the inflation rate was way higher than the core rate because you had all of these short-term product prices rising, and it caused the rate to get up. I think the CPI got as high as 9.1% year over year changes. I mean, 17%, I think, was the inflation rate in 1 month, the highest month. I mean, that was just outrageous. Then, of course, you see all of that reversed. So now the inflation rate has come down year over year. Spot commodity prices have fallen dramatically. I think oil went from $120 a barrel down to $90, $85 a barrel today. All of that has caused the inflation rate to look like it's much better than it really is. If you look at the core inflation, that has been rising steadily, and it rose last month just as well as the month before that. There has been no real damage inflicted on core inflation. That's where the solution has to be found, and it's not there. They're not doing the right job. And until they do, you've got all of these economic problems that are going to flow from higher inflation. Now, we've had a very bad economy since 2020. I mean, the beginning of 2020. Now, we had the pandemic, very understandable, but then we never recovered back up to where we should have. We're now about 6-7 million jobs short of where we should be had we grown steadily and caught back up. We have not. We are in a secular stagnation. The first quarter was negative GDP growth. The second quarter was negative GDP growth. I don't know what the Fed number is today, but I think it's less than 1% growth. We have a very sluggish growth now. That means that any tightening of demand would cause that to dip below zero and cause enormous damage to the output, employment, and production and the incomes of individuals. We think they're talk these big numbers like the unemployment rate and all these.
We have the Fed trying to reduce inflation. Of course, it's been late to the party behind the curve, but fiscal policy is only one aspect here. And we have an administration that's put out unprecedented stimulus and continues to do so, continues to spend. The so-called Inflation Reduction Act, that's just a slimmed down version of the Build Back Better bill with billions in spending on climate change initiatives. The administration just approving another $4.8 trillion of new borrowing.
There you go.
And we have a debt to GDP ratio of 123%. So there does seem to be a big disconnect here between fiscal and monetary policy.
The Fed's trying to control inflation. The fiscal policy is trying to increase inflation. If I can just talk about how that stimulus spending works. So it hurts the economy, and that's what all the stimulus spending does. That's why we are in a secular slowdown. Now this administration has just done it in incredible. What you say of 123.5% of GDP is correct. That went up from 82% of GDP very recently. That's 40 percentage points higher. That's a 50% increase in our debt to GDP ratio. That's unfathomable how much that is. We are paying people not to work, and we're taxing them if they do work. People are leaving the labor force in droves, and we're then pumping in huge amounts of money, and we wonder why we have an inflation and economy problem. The most primary cause of inflation historically is weak countries have weak currencies and high inflation. The U.S. has a very strong currency, and it still has high inflation.
Well, speaking of the dollar, it actually hit a 2-decade high today on concerns about escalations in the war in Ukraine. I know you're talking about a much longer term outlook there. And President Biden has actually also been blaming inflation on Putin, calling it a Putin tax hike. The Fed has also cited the war in Ukraine as a factor, which has certainly exacerbated the situation, but it's not the cause. And it seems that this war is about to intensify.
The war has added to inflation, but much more seriously, the war adds to a very high risk factor for everyone on earth. This is not a good thing. It's not just an economic thing. Wartime situations invariably lead to very high inflations for periods of time, and that is true, and that is happening. But much more seriously, it just adds to the inflation, the bad economy, and now we have a wartime risk in the United States.
What does the Fed do? I mean, is there any kind of capacity to handle any type of black swan event at this point?
The government can't control everything. What Powell has to do is let markets do what they do best. It's solve problems, let prices rise. That's what they're supposed to do in markets. When the demand exceeds the supply, the price is supposed to go up. If you keep that price from going up, you destroy all the supply side incentives of creating more of the product. So I would beg the Fed to get out of the business of controlling interest rates and let interest rates seek their own level. Then they should sell off the assets off the balance sheet, not at $2.57 a month. Make it a large buy where you set off $1 trillion a year and get those bonds out of the Fed's balance sheet back into the market so that interest rates can reflect what they should reflect. They should reflect the expected real return on capital over the maturity of the asset, and they should forecast the expected rate of inflation over the year maturity. The two together become the nominal yield. Bond prices should reflect the nominal yield over the period of maturity in a good market. That's where the signals really work. And everyone talks about free markets all the time, and free markets are never more important than during periods of crisis. They're not something that, the economy is fine, good, let's use free markets now. Oh my God, we're in a crisis, let's control the market. Just the reverse. You never need free markets more than you do when there's a crisis, and we are in a crisis.